one step back. I missed a fundamental model in Bitcoin. It's always difficult, even for institutional investors personally, it's always difficult to sell the fastest horse.
What do you think could be a bottom for this cycle?
Bitcoin has never had a monthly close below. So the stock to flow is quite interesting metric. My insight was one step back. I missed a fundamental model in Bitcoin. And being an institutional investor, okay, the technical analysis is nice and certainly helpful, but you need to have a more fundamental model from first principles that, like the capital asset pricing model, we'll talk about it in a minute, I guess, with the equity risk premium. The capital asset pricing model says, okay, if an asset is more volatile, it should give you more return. Yeah. And you cannot have a high return without that volatility, because then everybody would be a millionaire, right? It's only the people that can stomach that volatility will be able to earn the high return. And we as Bitcoiners are very into that, right? Because the volatility is so high. But the stock to flow model missed this. I missed this fundamental model. And that's where I, of course, read a lot about Bitcoin, the white paper, and then Savin's book. A must read, of course, for every Bitcoiner. And the scarcity part of Bitcoin is what jumps out. That's what caught me and a lot of investors. There's only 21 million. They're scarce. They're even scarcer than gold, because even when the price goes up, normally when the price of a commodity goes up, the producers produce more of it, bringing the price down again. But with Bitcoin, you can't do that. So it's a very, very fundamental thing of Bitcoin that it has this built-in scarcity. My insight was the scarcer an asset, the higher the market value would be, because people value scarce assets higher than non-scarce assets. It's just that everybody knows that. It's with watches, with art, with everything. So that's when my addition was to take the scarcity stock to flow ratio and then map that to the market value of several assets and even dynamically through time. That was the stock to flow model. And the stock to flow cross asset model then brought in the gold data and the silver data, real estate and diamonds. And then you see, like you would expect, that the scarcer the asset, so real estate is a scarcer asset, the higher its market value. And that's when I made this very rough. So it's a very rough model. It's a very simple model. It only has one input, and that is the scarcity, stock to flow ratio. All the other factors, including demand, but all the other, and all the macro news and China and bans and whatever. So there's like 100 factors that also impact the price. Those are not in the model. So the model is very simple. It's very rough. Yep. I think it's very intuitive and very directionally right. But demand is not in there. But demand is a very interesting variable, because that's very hard to measure, right?
You can't predict that, really.
No.
And anything.
And Bitcoin is sort of a strange commodity asset. It's like a Veblen good. And in Veblen goods, the laws of demand and supply don't work as you would expect. So, because normally, if a price goes up, rises of something, the supply of the demand goes down, and if the price goes down, the demand goes up. But with a Veblen good like Bitcoin or a Rolex watch, or a piece of art, when the price goes up, demand goes up. It's the other way around. And that's because it's viewed as a luxury good, as a store of value. So demand is a function of supply. It's derived from supply. So I think, and of course we could debate that, but I think that demand is a derivative of supply in the case of Bitcoin and other Veblen goods. Yes, I did not sell a Bitcoin, fraction of a Bitcoin. And especially in an institutional setting, of course, you have a mandate that you can have X% in some asset and Y% in another asset, and you have to keep your exposure within those mandates. If you start with 10% Bitcoin and that grows to like 80% Bitcoin because it doubles and doubles and doubles again, then you have to rotate out of that asset and into another asset. And I might say in an institutional setting you have to do that. Personally, I don't have that strict mandate, of course, for my own money, but it would be wise to have some kind of protection built in. And I have friends that have very simple asset allocation rules, like 25% in real estate, 25% in gold, 25% in stocks, and 25% in Bitcoin. I rebalance that yearly or quarterly or whatever. That would be like conservative. I think that would be not a bad approach at all. On the other hand, I must say, it's always difficult, even for institutional investors, but they're bound to their mandates. I am not personally. It's always difficult to sell the fastest horse. I sort of ignored the mandate, my personal safety for a little bit and let the fastest horse run wild. I am Bitcoin only because I like Bitcoin for the reasons it was made crusade against debasement and the whole battle of separation of state and money. I guess Bitcoin is the best in terms of decentralization, in terms of, a lot of things. But I can certainly understand from a pure investor's point of view that there are other cryptocurrencies like Ethereum.
That we may enter into a Bitcoin winter.
Yeah, first of all, I'm one of the few that indeed thinks that there will be a next bear market, a crash, like we've seen a couple times before. Because there's a lot of people right now saying that we're done with the 4-year cycle and we will not have that kind of volatility and that kind of deep bear markets anymore. I think we will have those bear markets. You can see it in the option prices. It's priced in at 100% volatility. You can see it a couple of months ago when the China banned the mining. We went down 50% or more. So we almost had it. We had a crash of 50% right there. That tells me that 80% when something really big happens, it's not out of the question yet. We'll go down 80% again. And I'm not looking forward to that, to be honest. Nobody probably is, but I guess that's part of the deal, and it's also part of the greed and fear that's in investors. People won't change. There will be FOMO. For example, hit the 100,000 level a couple of months from now, according to the stock to flow model. People will FOMO in, and it will go up. And then after that, something horrible happens. Another ban, another China ban or India ban or something, and everybody's scared again, and the fear sets in. So I guess that fear and greed is never going away in Bitcoin. And I see investors right now have a very limited set of assets that they could store wealth in. And it's real estate for sure. That's the biggest market, $100 trillion market. Of course, it's stocks and bonds, but in the commodity space. And it's gold and it's Bitcoin to a smaller extent because it's really a small asset with a $1 trillion market value. But, right now, some forward-thinking, innovative investors might be okay to put a couple million or maybe even more into Bitcoin, but not like 10 million or 100 million, where they would be perfectly okay to put 10 million in gold or 100 million in real estate. And I guess that will change in the next 10 years because Bitcoin will be more accepted more by countries and more legally, regulatorily secure, and the scarcity will grow, right? So Bitcoin is now a little bit less, about as scarce as gold, and investors have to get used to that. But of course, Bitcoin is much more portable than gold. You can take $1 billion in Bitcoin and you're on a USB stick or even with some words in your head, whereas $1 billion in gold, of course, is not possible to move that in your car. And the same is true for real estate. So you can not move real estate, and real estate is high maintenance. So I guess in a way, Bitcoin is the perfect store of value once it has the legal clarity and the regulatory clarity that it deserves.
What do you think could be a bottom for this cycle?
It has nothing to do again with the stock to flow model, of course. No. Just my personal opinion.
It's more like TA almost. Yeah,
almost TA. And of course, I did try to do that with the floor model, which epically failed in November and December, so I throw that away. But one thing I look at for bottoms is 200-week moving averages. I think that's at around 19,000 at the moment. So Bitcoin has never gone a monthly close, has never had a monthly close below the 200-week moving average. So that can be seen as a bottom. But then there's the realized cap, the realized price. You can do a 200-week moving average, a time interval, but then not equally weighted, but weighted with how much Bitcoins were bought in that month or period, and then weight that against the price. So you can weigh the price based on how much Bitcoins were traded at that price. And then you get a realized cap, a realized price, and that is much higher than the 200-week moving average. And so that's a much...
What is that currently?
It is 24,000, I guess. And depends how you... 24,000 based on the price of every Bitcoin, every single Bitcoin of the 18.9 Bitcoins out there. So yeah, but if you make that into... That number is heavily skewed by the lost Bitcoin and the first million Satoshi coins. So if you narrow the window down to, say, also 200 weeks or less, that number goes up significantly to in the 30,000-40,000 range.